Have you ever been planning a vacation and you check the prices and then a month later they've totally changed? Or maybe you've noticed that the cost of a new phone goes up and down. Well, it all boils down to this one huge global question. Who actually decides what your money is worth? In this explainer, we're going to pull back the curtain and find out.
So what's the secret? What makes a dollar, a euro, or a shekel gain or lose its power? You know, it's not some person in a back room pulling levers, and it's definitely not magic. It's actually a massive global marketplace that's moving 24/7. So let's dive in and break down exactly how it works.
Okay, so every country has something called an exchange rate regime. Now that sounds super technical, but think of it like this. It's just the official rulebook for how that country's money plays with all the other currencies on the world stage. There are a few different kinds of rulebooks, but today we're focusing on the big one, the system that most major economies use. And that system is called a floating exchange rate. Honestly, the name kind of gives it away. The value of the currency floats. There's no government official setting a fixed price. Instead, its value is decided by the constant push and pull of the free market. You know, just like the price of avocados or shares in a company. And it all comes down to two really powerful forces: supply and demand. To really get this, we've got to meet the two main teams in this game. First up, let's look at the buyers. These are the people and companies who are creating all the demand for foreign currency. So who are they, and why do they need to get their hands on money from other countries?
Let's call them team demand. On this team, you've got your importers, right? They need US dollars to buy American cars or euros to buy French wine. Then you have local investors who want to buy shares of a foreign company. You also have regular people just sending money to family overseas. And of course, you have speculators. These are traders who are betting the local currency is about to get weaker, so they're buying up foreign currency now, hoping to make a profit.
Now here's a perfect way to picture it. Imagine a huge pension fund in Germany wants to invest in Apple. Well, they can't just show up with a pile of euros to buy Apple stock. Nope. First, they have to go to the currency market and buy a massive amount of US dollars. That one move by one company creates a huge wave of demand for dollars.
So, if you remember just one thing about demand, make it this. Demand for foreign currency is all about money leaving the country. Whether it's to buy stuff, to invest, or to send a gift, it's cash that's heading for the exit.
All right, every market has two sides, right? For every buyer, there has to be a seller. So, let's meet the other team in this global match, Team Supply. These are the folks bringing foreign money into the country and looking to sell it.
And you'll see Team Supply is basically the mirror image of Team Demand. You've got exporters who just got paid in, say, dollars for a big international sale, and now they need to change it back to their home currency to pay their employees. You have foreign investors who need to buy local currency to build a new factory. Then there's foreign aid coming into the country, and of course speculators on this side too, but they're betting the local currency is about to get stronger.
Here's a great real-world example. Let's say an Israeli tech giant like Check Point sells its software to a huge American client and gets a check for $100 million. That's fantastic. But they can't pay their engineers in Tel Aviv with US dollars. They need shekels. So what do? They go to the market and sell those $100 million, creating this huge new supply of foreign currency.
And it's not just big companies. A massive source of supply can come from things like foreign aid. For example, the annual aid that Israel gets from the United States. We're talking about a huge number here, over $3 billion. That's a giant wave of foreign money that has to be converted, which seriously boosts the supply.
And there you have it, the other side of the coin. The supply of foreign currency is all about money entering the country. It's as simple as that.
Okay, so we've met Team Demand, the ones who want to buy foreign currency. And we've met Team Supply, the ones who want to sell it. So what happens when these two powerful forces actually meet in the marketplace? Well, that's where the magic happens. That's where the price is set.
The easiest way to see this is with a simple graph. You have the demand curve and it slopes down, which makes total sense, right? When a foreign currency is cheap, it's a bargain, so more people want to buy it. Then you have the supply curve, which slopes up. Again, totally logical. When a foreign currency is expensive or valuable, more people are eager to sell it and cash in on that high price.
The price, the actual exchange rate, gets set right where those two lines cross. That little intersection point, that's the moment of truth. It's where the buyers and sellers on the market have, for that split second, agreed on a value. And that's what we call the equilibrium exchange rate.
But here's the really important part. That equilibrium point isn't stuck in one place. Not at all. It's moving constantly, second by second,
as big world events shift the balance between team supply and team demand. So let's see what happens when one of those forces suddenly gets a huge jolt.
Let's play this out. Imagine a country's citizens suddenly start buying way more imported stuff. That means team demand just got way bigger, right? The whole demand curve shifts over to the right. And look what happens. The new meeting point, the new equilibrium is higher. The exchange rate goes up. This is called depreciation. It now costs you more of your local money to buy $1. Your currency just got weaker.
Now, let's flip the script. What if that same country's tech companies have an amazing, record-breaking year for exports? Well, now team supply is flooded with foreign cash they need to sell. The whole supply curve shifts to the right, and now the new meeting point is lower. The exchange rate goes down. This is called appreciation. It now costs you less local money to buy $1. Your currency just got stronger.
So let's just boil this all down. When there's more demand for foreign money, your currency depreciates. It gets weaker, and that vacation gets more expensive. But when there's a bigger supply of foreign money coming in, your currency appreciates. It gets stronger, and suddenly those imported gadgets look a whole lot cheaper. It's this constant dance between the two.
At this point, you might be thinking, okay, that's kind of interesting, but, graphs, curves, equilibrium, what does any of this actually have to do with my life? Well, the answer is pretty much everything. It directly hits your wallet.
When your currency appreciates, when it gets stronger, that trip you've been dreaming about to Italy suddenly gets a little cheaper. The hotel, the pasta, the tours, it all costs you less. That new smartphone that was made overseas, the price might drop. But when your currency depreciates, when it gets weaker, the price tag on all those exact same things starts to creep up. So in the end, the price of your money isn't set by some mysterious figure behind a curtain. It's set by millions of everyday decisions made by importers, exporters, investors, and tourists all over the world. It's all of us. And now that you know the forces at play, the next time you see a headline about a boom in exports or a surge in online shopping from abroad, you'll know exactly what's going on under the hood and what it means for your wallet.